Good evening, sir.
Good evening, Vinuta. Shall we start? Last time we had done up till conceptual framework. Let us come to why do we have a conceptual framework? What is the importance? What is the necessity for a conceptual framework? Now, the first point, you can write, you will be asked minimum 3 points over here. You can write any 3 points. It enables the accounting standards and the generally accepted accounting principles to be
Sir, I'm not able to hear. Nothing.
not able to hear.
I was not able to hear, sir.
Just check whether you have got your laptop volume on and increase the volume.
Sir, I'll re-log in, sir. I'm not able to hear.
Okay.
Good evening, sir.
Good evening. Good evening.
I'm now able to hear.
Okay. Are you able to see the book also, the soft copy?
Yes, sir.
Okay.
It's visible.
Fine. So the last time we had done the framework, conceptual framework, and I'd explained to you what is a conceptual framework, what is the importance of a conceptual framework. Now, why do we require a conceptual framework? That may be asked you in the examination. What is the importance? What is the need for a conceptual framework to be available? The first thing is that it enables the accounting standards and the generally accepted accounting principles to be developed in accordance with agreed principles. So that means whatever accounting standards you are going to prepare, whatever accounting standards you are going to draft, those will be on the basis of the conceptual framework. Second, it avoids firefighting. Now, firefighting means what? Firefighting means taking short-term decisions on a random basis. So there is a problem which suddenly comes into existence. I don't know how to deal with it. So a temporary solution is given for that particular moment and it is put to rest. That is called firefighting. So for example, a person comes late for an examination. Now I am not told, I am not instructed as to what to do when a student comes late for an examination. Whether I should allow the student to come, and after if I allow him to come, whether let us say the student is about half an hour late, whether he will get an extension of half an hour at the end, or he will get just out of 3 hours, half an hour has gone, so only 2.5 hours he will get. So I'm not having any instructions from the top. But I'm facing a situation where a student has come late for an examination by half an hour. So the question is whether I should allow him or not. So on the spur of the moment, I have to take a decision. Suppose I say, let us admit him for the exam, and I will give him extension of half an hour. So for the moment, the problem is solved. But then if it comes to be known to others that I have allowed a student late and that student has been given extra half an hour, then next time everybody will come late. So that means that particular solution that I have given does not become a trend setter, does not become a rule. I have just taken that decision for the spur of the moment as to how to solve that problem. I have taken that decision. That is called as firefighting a problem. Okay. So avoids firefighting, whereby accounting standards are developed in a piecemeal way in response to specific problems or abuses. Firefighting can lead to inconsistencies between different accounting standards and between accounting standards and legislation. So there is no uniformity. Now, in my class, a student has come late. I allowed the student, I gave half an hour more. Maybe in another room, another teacher has not allowed a student to enter the exam after half an hour. So there are inconsistencies. Whether that is a rule or this is a rule. So that is what has happened is that on the spur of the moment, I have taken a decision. So that decision may not be consistent. That decision may not become the rule. That decision may not become standard. So we want something standard. We want something concrete. We want something definite to happen. And for that purpose, we have conceptual framework. Okay. So it avoids firefighting. Firefighting can lead to inconsistencies between the different accounting standards and between accounting standards and the law. Lack of a conceptual framework may mean that certain critical issues are not addressed. Certain important issues are not addressed. And they have given the example of what? Asset and liability. So as I told you, even basic things like asset and liability were not defined. So you must have studied asset is what the company owns and liability is what the company owes. That is the definition that has been taught to you when you were in first year PhD. Am I right? You were taught the same principles, right? Now we come to know that that is a wrong definition of asset. That is a wrong definition of liability. So did our teachers teach us wrong? It is not that our teachers have taught us wrong. It is that at that point of time, there was no definition of asset or liability anywhere in any accounting standard, in any accounting rules. So whatever we felt right, we explained it to the students. So that becomes inconsistency because it is not the correct definition. So the lack of a conceptual framework may not address certain critical issues. Next point, as transactions become more complex and businesses become more sophisticated, it helps preparers and auditors of financial statements to deal with transactions which are not the subject of an accounting standard. Now, just a few years back, there was nothing called as financial derivatives. Now we are having financial derivatives. We are having forward contracts, future contracts, options, swaps, swaptions. So these are different financial derivative instruments which have come into existence. But before that, there were no financial derivatives and therefore there was no accounting standard. So when these things came into the market as a forward contract, a futures contract, a swap, an option, we did not know where to show this in the financial statements. Because there was no rule, there was no standard, there was no accounting standard, there was no rule. And these things were not known at all. They were totally new things. Now we have an accounting standard which deals with all these financial instruments. But now again a problem has come. You must have heard about cryptocurrency, right? Cryptocurrency now, if it is, if a company is dealing in cryptocurrency, how to show it in the financial statement? Whether it will be an item of profit or loss, whether it will be an item of balance sheet. If it is in the balance sheet, whether we should consider it as a non-current asset or a current asset. If it is a current asset, then what type of current asset? What should be the basis of measurement? How should we value that asset in the balance sheet? There's no accounting standard. There is no rule. There is no regulation. So we are still confused as to what is going to be the disclosure requirement of cryptocurrencies, where it will come, how it will come, how do we present cryptocurrency in the financial statements. So now even in the CPA community of USA, we are discussing, we are having, members of CPA. CPA members are given calls, are given letters, and I have received emails as to suggestions to be given. So they will collect all suggestions from all the CPA members before they form an accounting standard. They will take suggestions from people as to where it can be possibly put in the financial statement. So if I give a suggestion that it should come in the balance sheet, I should state where it should come in the balance sheet, why it should come in the balance sheet in that particular heading only, why not any other heading. So I will have to justify. Like me, there will be lakhs of other people who are giving their suggestions, who are giving their reasoning. So then the International Accounting Standards Board will take a decision at the end as to what should be the right way of disclosure and convert that into an accounting standard. So when new transactions come, it becomes difficult to give a particular decision as to where the financial transactions will be recorded in the financial statements. Right? So for that purpose, a guidance is there. A guidance is there as far as conceptual framework is concerned. So again, on the basis of conceptual framework, everybody is giving a suggestion. Cryptocurrency can be shown where in the financial statements. So for that also, we are taking the inputs from the conceptual framework. So it is a base for taking a decision, which will later on be converted into an accounting standard. Fine. So accounting standards are based on principles which are thought to be harder to circumvent. That means it is difficult to avoid an explanation that is given in the conceptual framework. Now, for example, a meaning of a word, I give you the example of Oxford Dictionary. The meaning of a word you are looking for in the Oxford Dictionary. Now, if the meaning is given, will you say that no, this meaning is wrong? No, you can't, because you know that for years the Oxford Dictionary has been the basis of English language. So you will not say that Oxford Dictionary is wrong. That means you have some belief in that, you have some faith in that. Likewise, the conceptual framework also. They are based on principles which are difficult to avoid, which are difficult to prove wrong. Okay. A conceptual framework strengthens the credibility of financial reporting and the accounting profession. It makes it less likely that the standard setting process can be influenced by vested interests, that is, large companies having a lot of money power, so they cannot influence the accounting standards easily. This is the approach used in the UK and by the board in its revised conceptual framework issued in March 2018. Alternatively, we have the rule-based system, but the rule-based system is not in UK, it is in US, as I told you. Purpose of the framework. What you have to remember here is the last part. The purpose of the framework is, this part you have to keep in mind. Purpose of the framework is to assist the International Accounting Standards Board, IASB, to develop the financial standards, that is accounting standards, IFRS standards, that are based on consistent concepts. Assist the preparers of the accounting standards to develop consistent accounting policies when no standard applies to a particular transaction. Now, for example, in cryptocurrency, we don't have any accounting standards. So we'll go on the basis of the accounting policies which are followed by a company. to a particular transaction or other event, or when a standard allows a choice of accounting policy. Assist all the parties to understand and interpret the standards. That is a basic purpose of conceptual framework. The framework is not in itself an IFRS standard. So that means I told you this before also. It is not law. Even the accounting standards are not law. They are not legal. For that to be implemented, we need to have legal laws. For example, we are having IND-AS, that is Indian Accounting Standards. There is no law that says that it is compulsory. If you don't follow, you will be put into prison. But there are other ways of getting it compulsorily done. For example, if you want to get your shares listed on the stock exchange, they will ask you a copy of your financial statements. And if that is not on the basis of the Indian accounting standards, they will not accept. So compulsorily, you have to follow the Indian accounting standards, right? So it means that we are not going to have a legal system for the implementation of the accounting standards, but we will ensure that we force you to follow the accounting standards, without which you will not be given some benefits. For example, simple thing like Aadhaar card. Now, if you don't have an Aadhaar card, people, sometimes refuse. There was a protest in between that we are not going to have our Aadhaar card. We are not going to show our Aadhaar card. So fine, if you are not going to prepare an Aadhaar card, you are not going to get the benefits which are associated with that. Now you say that I'm not going to prepare a passport of mine. There is no compulsion. If you don't prepare a passport, you will not be able to fly internationally. So that means if you want to fly internationally, you have to make a passport. You can't say that I will not make a passport, but I will fly internationally. How can you do that? So it becomes necessary for you to follow certain things. Though we don't see, there is no law which says that you should not have if you don't have a passport, we will put you in jail. Or that passport is a legal document that will, give you all the benefits as a citizen of a country. No. Nobody has said that passport is compulsory. Nobody has said that you should have a passport. There is no law. But if you want to travel abroad, you need to have a passport. So they will make it compulsory by their own means and standards, where they will have restrictions on you getting some benefits from the government. They will have restrictions on you listing your shares in the stock exchange. They will have restrictions on you becoming a company, because all this is in the hands of the government, the Ministry of Corporate Affairs, MC. So by squeezing those particular benefits, they will compel you to follow the accounting standards. Likewise, conceptual framework, it is not legal, it is not compulsory, it is not an IFRS standard also. It is a base which is used to prepare accounting standards. Okay, so if there is a conflict between the framework, the conceptual framework, and an IFRS standard, then what is supreme is the IFRS standard. So if there is a dispute as to what is correct and what is wrong, whether the framework is correct or whether the standard is correct, we will always say the standard is correct. We cannot say standard is wrong. We'll say that standard is correct. We will make changes to the conceptual framework. Objective of financial reporting. Why do we need to study the subject of financial reporting? Because every company, every business has to prepare financial statements at the end of the year. And the very purpose of preparing financial statements is to enable the readers of the financial statements or the users of the financial statement to understand what is going on in the company. And if they want to invest them, to help them invest in the company. If they want to remove their capital from the company, then helping them to remove the capital from the company. So we have to inform the investors as to what is happening. Therefore, financial reporting is necessary. Now we have qualitative characteristics of financial information. That means what should be the qualities of financial information, and in other words, the financial statements. Two main qualities are there. One is called as fundamental qualitative characteristic. and the other is enhancing qualitative characteristics. Now, it is like this. I say that every person normally, before we go out anywhere, before we go to office, before we go to college, we do our routine job of having a bath and then becoming clean, wearing clean clothes and going for the office work, going to college. Right? So that is a fundamental characteristic. Enhancing characteristic, some people may, after having a bath, they want to look good, they will do their facials, they will do their hair, they will apply cream, they will comb their hair, boys will be, grooming themselves properly. That is enhancing, adding to your existing features. But a basic fundamental that you should have clean clothes when going for the college. You can't wear shabby clothes and good. You can't wear unironed clothes and good. So that is basic, that is fundamental. So like that, information, certain information, fundamental characteristics, which should be there in everything. But now if you want to highlight them, if you want to enhance their qualities, then additional qualities, additional characteristics. Fundamental qualitative characteristics, only two of them, relevance and faithful representation. Enhancing qualitative characteristics, you have four. And those four we remember as V cut. V for verifiability, C for comparability, U for understandability, and T for timeliness. Right? So four enhancing qualitative characteristics, two fundamental qualitative characteristics. Let us look at them in detail. When we are talking about relevance, what does relevance mean? Information is relevant if it has the ability to influence the economic decisions. And it is provided in time to influence those decisions. Let us say that I'm going for an exam. When I'm going for an exam, a friend comes and tells me that it is one of your friend's birthday today, and therefore we have to wish that person and give him some sweets. Now, is that relevant information for him? No. Because you are going for an exam, if he has discussed something important relevant to the exam, then it is relevant for you. If he has told you some important questions, if he has told you that this is important, that is not important, that is relevant for you. But if he comes and tells you that, today is so-and-so's birthday, how is it relevant to your examination? It is not. So relevant information, it should have the ability to influence the economic decision of the user of the financial statement. Second, it will be relevant only if it is provided in time. Now, for international financial preparers of financial statements, in UK, US, etc., they normally have the calendar year, Jan to December. Now, at the end of December, you close your financial statements, you close your financial books. So the accounts have to be prepared by at least latest by March of the next year. So within 3 months, you have to prepare the financial statements, because that will go for income tax returns filing also. Because I think in US, the date of filing of returns is 8th of April or something like that they have. They have some odd date. I think even in UK, they have 8th of April as a last date of filing of your income tax returns and financial statements. So at least till that time, you should be able to file your reports. Now in India, we have this April to March financial year. So 31st July is the last date for individuals non-audit, that is where audit is not necessary, where audit is not compulsory, for those type of assessees to file their income tax returns. Individuals, partnership firms, and so on. 31st July is the last day. For corporates, it is 30th September. For those who are having tax audits, it is 30th November. So these are the last dates. But normally, in August or September, we have to call for AGM. That is the annual general meeting of shareholders. So before the month of August, at least by the month of July, your financial statements should be ready. So that means 3 or 4 months latest from the date of closure. Now, if you don't prepare the financial statements within that date, then obviously you will not get the benefits. It is not relevant. Because afterwards, if you are going to file your income tax returns, anyway, you will have to pay fines, you will have to pay the penalties. So there will be a fine, there will be a penalty. There will be interest calculated on whatever tax amount is outstanding. On that, the government will calculate interest for the number of days of delay. So for it to be relevant, it should be provided in time. So now the Income Tax Act in India also, they are having some provisions where if you don't file your income tax returns on time, certain benefits of tax will not be available to you. So if you file your returns late, it is not relevant because you are not going to get the benefits of tax. You are not going to get benefits of tax. Over and above that, there will be fines and penalties. So is it relevant of filing income tax returns late? No. It should be done timely. Okay. Suppose I have a lecture with you at 8:50 in the morning and I come at 9:20, 9:30. So half your lecture is gone. So it means that it is irrelevant whether I take the lecture at 9:20 or 9:25 because as it is I'm late. As it is I'm late. So it doesn't make a difference. It will be relevant if I'm running for my lecture and trying to be on time at 8. That is relevant. And if I reach 5 minutes late, it's okay. So what is relevant is that you have to be on time, in time. You have to prepare your financial statements. You have to inform. Suppose internal reports are required. Sometimes internal reports are required by management on a quarterly basis, on a monthly basis, as to what is happening in the company, to know what is happening in the company, and to rectify if necessary. The managements may require their internal departments to give quarterly reports or monthly reports. Now, let us say the first quarter ends, Jan to March, the first quarter ends. The report should be given by the 15th of April. Now, if the first quarter report is given somewhere in the month of July, it is of no use. So, timely means that it should be available on time for decision-making purpose. So, relevance means two things. It has the ability to influence the economic decisions and it is provided in time to influence those decisions. So the word here is and. So as I told you in the beginning, the words and or should be observed very carefully because if it is and, both have to be satisfied. If it is or, either one of them can be satisfied. Okay, then next is qualities of relevance. There are two qualities of relevance, predictive value and confirmatory value. Predictive value means that from the given data, you should be able to predict the future. So let us say you have got last 3 years data of revenue and profit and all these things. On that basis, are you able to predict the profit for the next year? Then it is relevant. Then the data that is collected is relevant for you. So it has got a predictive value. That means on the basis of data collected, you can predict what is going to happen in the near future. Confirmatory value. Last year, you saw the results of the last 3 years. Let us say in 2022, you saw the result of 22, 21, 20. And on the basis of that, you predicted the result for 23. Now in 2023, I will check whether your prediction of 2022 has come true. I will check whether your prediction of 22 has come true, which means I'm going to confirm whether your prediction has come true. And if it has not come true, then what are the reasons? So it should have confirmatory value, a predictive value and a confirmatory value. So predictive values enable the users to evaluate or assess the past, present or future events Confirmatory value helps the users to confirm or correct the past evaluations and the assessments. Now, next thing that we have got to know is materiality. Materiality is an entity-specific aspect of relevance. What do you mean by entity-specific? It means that what is material for one entity may not be material for another entity. What is material? Material means significant. What is significant for one entity may not be significant for another entity. What is important for you may not be important to your friend. So each person has got its own values, his or her own values. And for them, that particular item is significant. Now, for example, in my case, I sometimes carry a very simple pen, a ballpoint pen, simple pen. But I'm having some attachment to that pen because I've been using that pen for last 5 years, 10 years like that. So matter is that it is just a matter of 10 rupee pen or a 15 rupee pen. But somebody borrows it from me saying that, sir, I just want to write this, and then takes that pen home. Next day, I will ask him, where is my pen? He says, sir, 10 rupees ka pen you are asking, but that has got some value for me. It may not have value for that person. It is material for me. It is not material for that person. So sometimes it does happen that, your things which are there, you are having some emotional attachment to. Somebody takes something from there. You feel something that, hey, I've lost that. And it may be a matter of 10 rupees also, but you will say, no, tomorrow when you come, please remember to get my pen back. So sometimes people may feel, hey, why is he, doing these things or petty things? 10 rupees, it is like just a matter of 10 rupees pen. I will buy you a new one, sir. I don't want a new one. I want that pen only. So that means that has got materiality for me. It has got significance for me. I'll say that that is my lucky pen. So when I go to KJC, that is Christu Jayanti College, last year I went to the college. It was my first lecture last year. And I was given a particular room, 402. And it proved to be lucky to me because I was teaching one batch over there. I got another batch in the same college. One was an MBA batch, one was a BCom batch. So I said that room is lucky. This year, when the rooms were allotted, I asked the coordinator, ma'am, please give me 402 only. He said, why? I said, it is a lucky room for me because that room has got some significance for me. So like that, what is material for me may not be material for somebody else. What is material for one entity may not be material for another entity. One entity may be having its total turnover as $5 million. So for a $5 million company, $1 lakh is a significant amount. $1 lakh is a significant amount. But suppose we are having a company whose turnover itself is $5,000 billion. $5,000 billion. For that company, even an amount of $1 lakh may be an insignificant amount. It may be a petty amount. So sometimes the significance depends on the value of the item. Sometimes significance depends upon the circumstances, the transaction, the event. For example, let us say an amount of $1,000 is not written in the statement of profit or loss. An expense of $1,000 has not been written in the profit or loss. I say forget it because company is having a big turnover, so that $1,000 doesn't make a difference. Forget it. We don't have to change the entire accounts just for that $1,000. But suppose the $1,000 is depreciation not charged on an asset. Same $1,000, same amount, but it is actually depreciation not charged on the asset. I say, hey, you have to write that $1,000. Redraft the entire statements. Why? Because otherwise it will be amounting to depreciation not disclosed. Depreciation not charged means assets are overvalued. Assets are overvalued means balance sheet is not giving a true and fair. So that is not a great significance. Amount is same. but one is a matter of principle, which is affecting the fairness of my financial statements. So that is significant. Sometimes in audit, we have what is called as a threshold quantity. So when I go for audit, I tell all my assistants that when you are verifying the vouchers, when you are verifying the expenses, don't verify figures below 5,000. Only figures above 5,000 you will verify. And if there is any problem, you bring it to my notice. If it is below 5,000, just forget about it. So small amounts are not considered seriously. So what is the threshold there? 5,000. So that becomes a material item for me or material amount for me. Anything below 5,000 is immaterial. So that is a threshold quantity. A threshold quantity is one that needs to be studied before considering the other qualities of that information. It is like a cutoff point. If any information does not pass the test of materiality, it does not need to be considered further. So an amount, an expenditure has not been recorded. If it is not exceeding 5,000, I'll say ignore it. Okay, that is the concept of materiality. Then we have something called.
Sir, I had a doubt.
Yeah.
Sir, can you give me the meaning of threshold?
Threshold
I'm
is a
writing
cutoff
it.
point. Threshold is a cutoff point.
Cutoff point.
Yeah.
Okay, sir. Thank you.
Next one is faithful representation. Faithful representation is from three characteristics. When do you consider the information given to you as faithful, which you can rely upon? Faithful is something that you can rely upon. When will you consider that? When it is complete, when it is neutral, and when it is free from error. Complete, neutral, and free from error. We always say half knowledge is dangerous. Likewise, half information is also dangerous. You can't just give incomplete information. Information that is given in the financial statements must be full. It should convey whatever has to be conveyed in full. So it should be a complete information. Second, it should be neutral. Neutral in the sense, it should be not biased. Or for example, I am preparing let us say, financial reports of my company. I'm preparing my own accounts, my own company accounts. And I find that my company is actually going into a loss. And I will have to show a loss. I say, no, I can't do this because it's my company. My reputation will be spoiled. And I try to manipulate the figures to show a profit. So that means I'm not preparing the financial accounts on a neutral basis. I'm biased. So I'm trying to show a favorable picture of my company because I don't want people to feel that my company is a loss-making company. So neutrality is not there. I am biased towards my company. I want to show my company as a profitable company. Free from error. The information should not be containing any errors, any wrong information, any misinformation. It should not be hiding some information. It should not be untruthful. So these characteristics must be there. So these characteristics are there, then the faithful representation is there. Coming to enhancing qualitative characteristics, as I said, we cut. Verifiability, comparability, understandability, timeliness. Starting with comparability. Comparability, the financial statements which are prepared should be comparable within the company. That means I should be able to do intra-period comparison. That means data of the current year with the data of the last 3 years, I should be able to compare. Secondly, I should be able to compare my financial statements with my competitors' financial statements. So comparability, that feature should be there. Verifiability. anything that is mentioned in the financial statements should be verifiable by the user of the financial statements. For example, I'm showing salaries and wages paid to employees as $320,000. Shareholder comes to me and asks me, how did you get the figure of $320,000? So I show him all the salaries which are paid to all my employees. The total of that comes to 3,20,000. That means I should have some concrete evidence with me, which can be verified by the user of the financial statement. Sometimes the evidences are direct, sometimes the evidences are indirect. For example, what is appearing in the balance sheet as inventory of finished goods? How do I know whether it is correct or not? I will go to the stores and I will do physical count of the goods over there. I will physically count how many items are there in the stock. So sometimes the evidence is verifiable directly, direct evidence is there. Sometimes indirect evidence is there. Let us say company has shown some sales made to some customer. The first evidence will be the sales invoice. So I'll ask the company to produce a sales invoice. Let me check. This says sales invoice is lost. We can't find where the sales invoice is. I tell them, fine, you don't have the sales invoice. Tell me which customer you have sold. So they tell me the name of the customer. I will send a letter to the customer or an email to the customer and ask him to verify the sales, verify that he has purchased the goods. This confirmation comes, that means goods have been sold. So the sales invoice was a direct piece of evidence. The customer's acceptance is an indirect piece of evidence. Right? And the last one is timeliness, not the last one. Timeliness means having the information at the right time so that decisions can be taken in the right time. And those decisions can influence, those details can influence my decision-making process. Then we have understandability. Understandability means that my financial statements or my financial reports should not contain any technical words which the user of the financial statement will not be able to understand. Of course, we assume that those people who are reading the financial statements are having some financial knowledge. It's an assumption, a basic assumption that we make, that they have got some financial knowledge and that they will understand some basic terms of the financial industry. But we cannot expect them to be experts in finance because there are lakhs of shareholders of a company who may not know to read and write also. They have just invested in the shares of the company because somebody has told them it's a profitable company. They have invested. But they are not able to understand technical things that you write over there. So don't use any hi-fi technical language which a normal basic reader or user of the financial statement will not be able to understand. Okay, that is understandable. Any difficulty up to there? Everything clear? I have sent one PDF across to be given to you for solving in the class tomorrow. Has ma'am forwarded that PDF of AFM, Advanced Financial Management?
Yes, sir. I'll check, sir. 1 second. Yes, sir. Revision of AFM, 2 pages.
Yeah, correct.
Yes.
So now coming to the definitions, as I told you, in the early days, we did not have the definition of an asset and liability. What did we define as an asset? We defined an asset as what a company owns. And we defined a liability as what the company, what is the word? Liability is what the company,
Is indebted to.
what the
Is
company
it?
owes. First one is owns, the second one is owes, OWES, right?
Yes, correct.
Asset is something what the company owns,
Hmm.
and liability is something what the company owes.
Oh, yes.
This is what you studied in PUC, right? Now, which means that you will show an asset in the balance sheet only if you are the owner of the asset. Am I right? Or will you show any asset that you like? Will you show any asset that you like, or will you show only assets that you own?
Only assets that the company owns, sir.
Okay. Now, suppose you have sold an asset to me.
Hmm.
Will you show it in your balance sheet, or should I show it in my balance sheet?
Your balance sheets.
My balance sheet. Why?
Because you have received the good, the asset, so it will appear in yours. Actually, in both, sir. From in my balance sheet, it will show that it is sold, and your balance sheet, it will show it is purchased.
But it will go out of your balance sheet. No? You will show the value as zero, isn't it?
Yes, sir.
If you have got a land of $100,000 and you sell that land to me,
Hmm.
you will show that $100,000 less sale of land, $100,000 balance is nil, no?
No, sir.
Right? You have sold the land, no? Why will you show it in the balance sheet? If you have sold the land, it should be cancelled from your balance sheet.
Yes, sir.
Correct now? So I will show the land in my balance sheet.
Yes, sir.
Now tell me why I will show it in my balance sheet.
It is because you own the land and you bought the land.
Okay. So that means if I am the owner of the land, I can show it in the balance sheet. Suppose now I have got some machinery, and till last year I was using that machinery for my business, and it was there in my balance sheet for $50,000. Now in the current year, I have sold the machinery of $50,000 to you. Who will show it in the balance sheet? You will show it in your balance sheet, or I will have to show it in my balance sheet?
I will show it in my balance sheet, sir.
Why?
Machinery purchased 50,000.
Why
Because
will
I own the asset.
you own the asset?
And
So is there a possibility where you will show an asset in the balance sheet even if you don't own the asset? Is there a possibility? You are not
no,
the
sir.
owner of the asset, but you will show it in the balance sheet. Is it a possibility?
I don't know, sir.
Why you don't know?
So goodwill,
Goodwill also you are
goodwill.
the owner. You are the owner. No? Your goodwill you will show in the balance sheet. Yes or no?
Yes, sir.
Now you are staying in your own house. You say that this is my house. Now you sell the house to me. Will I show it as my house, or will you show it as your house?
Your house, sir.
I will show it as my house. Why will I show it as my house?
Because you own the house.
Okay. Same way, if I sell a house to you, I'm having a house, I sell it to you. Will you show it in your books, or will I show it in my books?
In my book, sir.
Why will you show it in your books?
Because I am the owner of the asset.
But I will say that in certain cases, I will not allow you to show it in your books, even though you are the owner. Is it possible?
Maybe like in an apartment, if you have purchased a flat,
No.
only the flat belongs to you, but not the apartment.
Okay. So I'm selling a particular house to you. An individual house is sold to you. Will you show it in your
So
balance sheet as your property, or will I show it in my balance sheet as my property?
It is still your property, sir.
Why? I have sold the property. Who will show it? You will show it in your balance sheet, or I should show in my balance sheet?
The owner of the asset will have the title, sir.
Okay, so who's the
Ownership.
owner now? If I sell the house to you, who's the owner of the house?
I will be, sir.
You are the owner. So you will show it in your balance sheet.
Yes, sir.
But can I prevent you from showing it in your balance sheet?
No, sir.
You are the owner.
No, sir.
I can. Because you are going by the older definition that you have learned, that asset is what a company owns. But that is not the correct definition of asset. Ownership has got nothing to do with showing of an asset in your balance sheet or not. So there may be situations where you are not the owner of the asset, but still you are showing it in your balance sheet as your asset. Same way, you may be the owner of an asset, but still you will not show it in your balance sheet. I will show it in my balance sheet, because assets are shown in the balance sheet, not because we own the asset. Assets are shown in the balance sheet because we have control over the asset. So ownership
Yes.
is not the criteria. Control is the criteria. I may
Yes.
sell a house to you. I may sell a house to you. You become the owner of the house. But if I'm controlling that house, then I will show it in my books as my balance sheet. Let us say I sell a house to you, which has got 4 rooms. And I tell you that one of the rooms, you have to let it out for a paying guest. These are my terms, that if I sell the house to you, one of the rooms you have to let it out to a paying guest. So you are the owner of the house. But can you decide how to use the house? No. I am telling you that you can't use all the 4 rooms. You have to use only 3 rooms. So who's controlling? I am controlling. I am telling you that one of the rooms you have to let out for a paying guest. So it means that even though you are the owner of the property, you don't have control over the property, because I put a condition on that sale. So now you have to learn the new definition of asset, which does not have the word ownership, but it is replaced by the word control. So what is an asset? An asset is a present economic resource. A present economic resource which is coming into existence because of a past activity or a past event. A present economic resource which is controlled by the entity, not owned by the entity, controlled by the entity. So let us see the new definition of asset. New definition of asset is a present economic resource which is controlled by the entity. There is no word ownership here. The word is controlled as a result of past events. You must have purchased the asset a year back, and because of that, now you are showing it in your balance sheet. So on account of some past activity, you are the owner of, or rather you are controlling the particular asset. Okay. So control of an asset by the entity as a result of past events, that is called as an asset. Now, what is an economic resource? An economic resource is something which has got the potential to earn future economic benefits or future economic cash flows. Economic resource is something which has got the potential to earn economic benefits or economic cash flows in the future. Okay. For example, we can take land and building as an economic resource, because if I let out that land or I let out that building for rent, I can get rent as a future cash flow. So cash flows will arise from letting out the property, right? If I use the property myself as an administrative office, I use the building myself as an administrative office. So then also it will result in future economic benefits for me. Okay. So an economic resource, a present economic resource, which is controlled by the entity as a result of past events. That is called as an asset. What is a liability? A liability is a present obligation of the entity. What is the obligation? To transfer an economic asset, an economic resource, as a result of past events. You have purchased raw materials on credit basis from a supplier. Last month, you have purchased raw materials on credit basis from the supplier. Supplier has given you 3 months credit. So for 3 months, you will not make payment, but you will have an obligation pending. You have a present obligation, and that obligation is to transfer an economic resource. What is an economic resource? An asset. Economic resource is an asset. What asset you are going to transfer? Cash. You are going to pay the supplier cash. Cash is an economic resource. Cash is an asset. So present obligation of the entity to transfer an economic resource as a result of past events. That is called as liability. Okay. Third is equity interest. Normally we say equity interest is nothing but shareholders' interest. Shareholders' funds. Again, that definition is wrong. Again, that definition is wrong. Equity interest is the balancing figure. There is no definition of equity interest. It is a balancing figure. It is a residual value that remains after you deduct the liabilities from the asset. It is a residual interest in the assets of the entity after deducting all the liabilities. So your formula I have written over there. What is the formula that you're having? Equity is equal to assets minus liabilities. So as such, there is no definition of equity as such. It is a difference between assets and liabilities. It is a balance of assets that remain after all liabilities are paid. Okay.
Sir, so is equity and capital the same?
Equity and capital is same, but we don't say that equity is capital. We say that equity is a balancing figure after liabilities are deducted from the assets. It is the same thing. It is capital plus the undistributed profits.
Yes.
Okay.
Okay.
Next, you have income. Normally, we say income is what comes in, is income. No. Income is an increase in the value of the assets or a decrease in the value of the liabilities. You are selling goods to get revenue. That is income. What does it do? It increases your cash balance. Cash is what? Asset. So increase in asset. You say, sir, it is a credit sale. Okay, fine. It will increase your accounts receivable. Accounts receivable is an asset. So increase in an asset or a decrease in a liability is equal to income. So by increasing the asset or decreasing the liability, what actually happens? Equity increases. Equity increases. Because let us say your equity is equal to, as per this formula, say it is 6 lakhs minus 4 lakhs. So it is how much? 2 lakhs. There is an increase in asset, liabilities remaining the same. Suppose this becomes 7 lakhs minus 4 lakhs. What will happen? Equity will increase to 3 lakhs. So increase in asset means increase in equity. Suppose the asset remains the same and liability decreases. You have 6 lakhs as asset. Liability decreases to 3 lakhs. What will happen? Equity will increase to 3 lakhs. So any increase in asset or any decrease in liability, which results in increase in equity, that is income. Same way. And expense will be the opposite of this. Any decrease in asset or increase in liability, decrease in asset or increase in liability is an expense. Salary paid. What is happening actually? Cash is going out. Cash is going out means cash decreases. Asset decreases. Increase in liability. You have purchased raw materials on credit basis. It's an expense. But what has happened? It has resulted in increase in creditors. Liability increases. Okay. So decrease in asset and increase in liability will be called as expense. And decrease in asset and increase in liability will result in decrease in equity. Okay. So what do we conclude from this? We conclude from this that assets and equity are directly related. Liabilities and equity are inversely related. As asset increases, equity will increase. As asset decreases, equity will decrease. Liability may, it will be ulta. Liability increases, equity will decrease. Liability decreases, equity will increase. Point is clear? Okay. So we'll stop here for today. We'll continue in the next session. When is the next session?
Tomorrow, sir.
No, tomorrow's I've shifted to today. Tomorrow's lecture I've shifted to today. So Thursday lecture is shifted to Wednesday. So you will be having Monday, Tuesday, and Wednesday. And I think Friday is there, if I'm not mistaken.
Yes, sir.
So
Yes, sir. Friday. Okay, sir.
Wednesday and Friday, it will be in the evenings. Monday and Tuesday, it is 2 o'clock.
Okay, sir.
Right?
Yes.
You are having the soft copy, you are having the book now, Kaplan book. So revise from there whatever has been done on a regular basis. And see if you are able to recollect what has been, like, for example, definitions of asset. These are 5 elements of financial statements. What you have to do is you have to remember those 5 elements, at least as far as writing of the concept is concerned. Simple things. For example, asset is an economic resource. Words are important. Controlled by the entity. Arising on account of past events. Even that much, if you remember, it is more than sufficient. You don't have to remember each and every word from there. The basic point should be there. First is that controlled by the entity, not owned by the entity, controlled by the entity. So word controlled is important. Economic resource, you have to write the word economic resource. Liability, present obligation. Those 2 words are important. Present obligation. Income, increase in asset, decrease in liability, increase in equity. Remember these 3 things. That is income. For expense, decrease in asset, increase in liability, decrease in equity. Okay? Sure.
Yes, sir.
So tomorrow morning you are having my session. What time you are having? 10:50 now?
Yes, sir.
10:50 to 12:30.
Yes, sir.
Okay.
Okay, sir. Thank you, sir.